Visa and Mastercard interchange fees are projected to exceed $200 billion in 2025, following a record-breaking $187 billion in 2024, according to the Nilson report. That figure never appears on a single receipt, credit card statement, or consumer disclosure anywhere in the economy, and it costs the average American household approximately $1,200 per year in higher prices for everything they buy. Interchange fees have tripled since 2009, when the total stood at $62 billion. The growth rate has outpaced inflation, outpaced wages, and outpaced almost any other embedded cost in American commerce. Visa and Mastercard collect this money without selling products, without lending money, and without carrying any credit risk when cardholders fail to pay their bills. One comparison makes the scale concrete. Average credit card interchange runs 2.35% of every transaction. The average supermarket profit margin sits at 1.7%. Visa and Mastercard extract more from your grocery purchase than the grocery store earns from it, meaning the processing fee exceeds the profit from the sale itself. Merchants absorb interchange and raise prices to compensate. Those higher prices land on everyone, including the roughly half of lower-income Americans who carry no rewards cards and pay with cash or basic debit. Premium cardholders receive points and cash back. Cash customers receive only the inflated price. When payments consultancy CMSPI included all processing components, their 2024 total reached $236 billion, pushing the household cost closer to $1,800 annually. Either figure represents one of the largest hidden costs in American consumer life. To understand how $200 billion stays invisible, you need to see what happens in the 2 seconds between card swipe and merchant payment. When you pay $100 with a credit card, the merchant receives approximately $97.80. The missing $2.20 splits between your card-issuing bank, which takes roughly $1.75 as the interchange fee, the network itself, which takes about 15 cents, and the merchant's payment processor, which takes 7 to 22 cents. I spent considerable time trying to decode Visa's 24-page interchange schedule with its hundreds of rate categories. Rates vary by card tier, merchant type, and transaction method, updating twice yearly in April and October. The opacity is not a flaw in the system. The opacity is the system working as designed. Here is what the Federal Reserve found when they studied this structure. Competition among payment networks tends to increase interchange charges, not decrease them. Visa and Mastercard do not compete to lower fees for merchants. They compete to raise fees for banks. Higher interchange means more revenue for issuing banks, which funds richer rewards programs, which attracts more cardholders, which forces more merchants to accept the network because refusing Visa means turning away hundreds of millions of American consumers. Networks compete for banks. Banks compete for cardholders. Merchants have no leverage, and the people paying inflated prices have no idea the fee exists. The result of this competitive structure is a $15 billion annual wealth transfer, documented by the Federal Reserve, flowing in exactly the direction you would not expect. 3 economists at the Federal Reserve Bank of Boston, Scott Hsu, Oz Shai, and Joanna Stavins, published a foundational study in 2010 titled "Who Gains and Who Loses from Credit Card Payments?" The Boston Fed economists traced where interchange revenue originates, traced where rewards payments flow, and calculated the net transfer. Each cash-using household in America pays approximately $149 per year to card-using households through inflated retail prices. Each card-using household receives approximately $1,133 per year from cash users. Households earning under $20,000 annually pay a net $21 to $23 in transfers. Households earning over $150,000 receive a net $750 to $756. What the Boston Fed discovered in 2010 was confirmed again by the Federal Reserve Board in 2023. The transfer is not just continuing, it is accelerating. When I first encountered the Federal Reserve Board's updated research, the scale stopped me cold. Using data on more than 200 million credit cards, the Federal Reserve Board study found $15 billion flowing annually from less educated to more educated, from lower income to higher income, and from high minority zip codes to low minority zip codes. Cardholders with FICO scores above 780 earn net positive returns from rewards programs. Cardholders with FICO scores below 660 lose approximately $40 per month on those same programs. A 2025 study by the New York Fed and FDIC revealed that 86% of interchange revenue flows directly into rewards programs. The top 6 U.S. card issuers spent $67.9 billion on rewards in 2023 alone. That $67.9 billion came from elevated prices paid by everyone, returned only to those with premium cards. Economists call this structure the reverse Robin Hood. The transfer runs from those with less to those with more, hidden inside every price tag in the American economy. The question becomes how this transfer stayed invisible for so long. The answer involves a contractual architecture designed specifically to prevent merchants from revealing what they pay. From the early 1970s until January of 2013, every merchant agreement with Visa or Mastercard contained a no surcharge clause prohibiting any additional charge when customers paid by credit card. Retailers could not disclose the fee, could not price it separately, could not signal its existence in any form. For more than 4 decades, nearly $200 billion stayed invisible by contractual design. 2 additional rules completed the architecture. The Honor All Cards rule required merchants accepting any Visa card to accept every Visa card, from basic consumer cards at 1.5% interchange to premium infinite cards at 2.4% or higher. Anti-steering rules prohibited merchants from verbally encouraging customers toward cheaper payment methods until a 2010 Department of Justice settlement relaxed these provisions. The 2017 Supreme Court case, Expressions, Hair Design versus Schneiderman, ruled 8-0 that surcharge bans regulate speech, not merely commercial conduct. Prohibiting surcharges controlled what merchants could communicate about their own costs. The Supreme Court recognized the contractual gag order as exactly that. Today, roughly 1/3 of American businesses add credit card surcharges, up from under 5% in 2021. Connecticut and Massachusetts still ban surcharging entirely. Most merchants, facing customer confusion and competitive pressure, absorb the cost and raise base prices instead. The fee remains hidden. Understanding how this system became permanent requires examining who transformed it from a bank cooperative into a trillion-dollar extraction mechanism. Mastercard's IPO on May 25, 2006 raised $2.4 billion. Visa followed on March 18, 2008 with $19.1 billion, the largest initial public offering in American history at that time, oversubscribed even as the financial crisis accelerated. Today, Visa maintains a valuation in the range of $600 billion. Mastercard exceeds $450 billion. Combined, the 2 payment networks surpass $1 trillion in value. Mastercard's stock has grown more than 10,000% since its IPO. Visa's net profit margin exceeds 50%. Neither Visa nor Mastercard lends money, carries consumer debt, or bears credit risk when cardholders default. The 2 networks operate infrastructure through which $11.9 trillion in annual U.S. card transactions flow, collecting fees on every one. The United States remains the only major developed economy that has not regulated credit card interchange. The European Union caps credit card interchange at 0.3%. Australia averages 0.5% under central bank regulation. American interchange rates run 6 to 7 times higher than Europe's. The Durbin Amendment, passed in 2010, capped only debit card interchange for large banks. A federal court vacated even that limited regulation in August of 2025. While the ruling initially froze these caps, the ongoing appellate battle in early 2026 has left merchants in a state of fee volatility. The Credit Card Competition Act, which would extend Durbin-style rules to credit cards, has been introduced repeatedly since 2022 with bipartisan sponsorship and presidential endorsement. The Credit Card Competition Act has never made it out of committee. The payments industry has spent over $80 million lobbying against interchange regulation. Visa alone spent $7.72 million in 2024. The system that charges Americans $1,200 per household per year, that transfers $15 billion annually from lower-income to higher-income Americans, that remained invisible for 4 decades through contractual design, was built by specific institutions making specific choices over 60 years. Interchange fees persist not because change is impossible, but because Visa, Mastercard, and the banks that profit from the current structure have the resources to ensure change does not happen. The fee that never appears on your receipt is working exactly as intended. You're legally required to buy auto insurance, but you aren't told why the price just jumped 39%. In the next investigation, we're exposing the $33 billion mistake.